Welcome to week 5. I hope you've enjoyed weeks 1 through 4. This week we take on chapter 5, which is the balance sheet and the statement of cash flows. Now, our treatment of statement of cash flows is going to be fairly light. We're going to add a little detail onto what you learned in principles of accounting regarding the statement of cash flows. Hopefully you've prepared one there. There's a whole chapter on the statement of cash flows later in Intermediate 2, where we learn everything in a lot of detail. But to make the financial statements complete, we want to have a little review of the statement of cash flows. However, the balance sheet is going to introduce some things to you that I don't think you've seen before. And this is the importance of categorizing the items that appear on the balance sheet. Now, the most important distinction for our purposes and for the users of financial statements is the distinction between current assets and liabilities and non-current. And the definitions are important as well. Those definitions are in your textbook. I won't write them here. I'll just say them quickly so you can think about them. But those definitions are going to be important. And when you see how we display things on the balance sheet in corporate financial statements, you'll see that those two things have prominence. Current assets are those assets you expect to use up, spend, convert to cash within 1 year or one operating cycle, whichever is longer. Okay? 1 year or one operating cycle, whichever is longer. Now, in most cases, it's a year. Some firms have an operating cycle that lasts longer than a year. Now, remember, operating cycle is the cycle that goes from cash to cash. We have cash. We use it to buy raw materials or to buy inventory that we and then we sell the inventory, and then we collect the cash. Okay. For some firms, that's longer than a year. Maybe a construction company or someone that builds airplanes or yachts or ships. Operating cycle might be longer than a year, but for most firms, it'll be a year. Now, on the other hand, we have current liabilities. And current liabilities are those liabilities whose liquidation, the payoff, the satisfaction, is expected to require the use of current assets, or assets currently classified as current assets. Current assets are creation of a new current liability. Okay? So we can have some things that are short term, and because the circumstances are reported as non-current, and things that are sort of long term in nature because of the situation we're in, or that we might report them as current. Let's just do one for an example. Let's say that you have a bunch of notes payable, and they all come due within 3 months. We're in December, these are coming due in March. That's a 3-month liability that is short term. We would normally think of that as a current liability. But if we're not going to use current assets, say we intend to issue some stock and use the money we get from issuing the stock to pay off those current liabilities. Therefore, the current liabilities will be paid off without the use of what we're reporting as current assets, and therefore would not be current liabilities. Okay, even though they're short-term in nature, even though they're due in 3 months, we're not going to use current assets to pay them off. We're going to use stock to pay them off. Therefore, they are not current liabilities. Now, what I'd like to do now is to show you some how we report assets and liabilities on the balance sheet. So let's start with assets. Okay, so here's a company called Acorn Energy. It's a medium-sized company. They're reporting their numbers in thousands, notice. And so we have $34,280,000 of cash. Notice the titles. So we have a section called assets. Within that, a subsection called current assets. We list the current assets, cash. We have some deposits, some funds in escrow, we have accounts receivable, some unbilled revenues and inventory, some other, which gets us to total current assets. Okay. Now, the total current assets number is a number that's often used for decision making. It's important. Okay. Notice also that the assets here in this section are listed in the order of their liquidity. Cash is already cash. Okay. Investments can be easily converted to cash. But we have things like receivables and inventory. Okay, receivables just have to be collected. Inventory has to be sold and then collected. So liquidity. Cash is most liquid, then receivables, then inventory, and we put the miscellaneous other things. Okay, notice that we only have one item that's below less than, what would that be? Well, one item that's obviously smaller than the others. We try not to report immaterial things, so all the small things are combined into one item here at the bottom. Now, notice there is no section called non-current or long-term assets. We just end with current assets, list all the other assets, and end with total assets. Okay, so this is just an illustration that current assets are the most important thing. We've got to make sure we get that number right. All the other assets add up to total assets. When people think of assets, they say, how many current assets does the company have? How many total assets? No one asks how many non-current assets the company has. Okay. All right, then we move our way down to the liabilities and equity section. Notice the other part of the balance sheet is called liabilities and equity, or liabilities and owner's equity. Here we have current liabilities, and there's no specific order required, but we have some short-term bank and some current maturity of long-term debt. We have accounts payable, and we have the accruals. There's some deferred revenue and some other current liabilities. We can take all the small ones, miscellaneous ones, add them all together, and we get total current liabilities. Now notice this company is the only one I could find actually that calls all the other liabilities non-current liabilities. So we ought to get used to using the terms current and non-current rather than short-term and long-term. Okay, with current liabilities, non-current liabilities, current assets, non-current assets. I know your authors have a section called long-term liabilities. Non-current liabilities would be a preferred way to refer to that. In the equity section, we have three types of equity. Well, several types of equity, but we don't normally put them in sections either. So notice we have here common stock with its additional paid-in capital. This is what we call the paid-in capital portion. And then you have the retained earnings. In our case, the company doesn't have any retained earnings, has negative retained earnings, so they call that an accumulated deficit. And then we'd have other things like treasury stock or shares or non-controlling interest would be reported here. Okay, so that's a balance sheet. That's one example. Let me find another. I think this can be instructive. Oh, how did that get in there? Let's see. World of Warcraft. How did they get there? Because we are looking at the financial statements of Activision, who creates that kind of stuff. Okay. Now let's have a look. These guys are in millions. It's a bigger company. So they have almost $4 billion in cash. Okay. Assets, subsection called current assets. So list all the current assets in the order of their liquidity. We get total current assets. Then we do all the other assets. Now there's no title here. We just come down to all the other assets, and we list total assets. Okay. Then in the current liability section, we list current liabilities, and we get total current liabilities. And then we just list the other liabilities. Notice there's no title this time. List the other current liabilities. We get to get the total liabilities. Okay. Now notice in the stockholders' equity section we have a few things. We have the stock, which in the additional paid-in capital, which is the paid-in capital portion. We have the retained earnings. And then we have the accumulated other comprehensive loss. So remember we talked about comprehensive income in the last chapter? So the portion of comprehensive income that comes after net income, the retained portion of that is reported here as accumulated other comprehensive income. Okay. There's another example. We'll try one more. Maybe we'll try two more. Just one more. Okay, now in this case, we have current assets. Notice we list them all. Current assets, trade accounts, accrued revenues, related party receivables, derivative assets, other current assets. List them all here as total current assets. Then we have another title called property, plant, and equipment. And notice in the other examples we gave, property, plant, and equipment was recorded and reported on one line. Let me remind you, I'll show it to you again. Property, plant, and equipment here for Nathan's famous hot dogs is reported as one line. So all the buildings, equipment, furniture, land, everything, minus accumulated depreciation reported on one line. And why is that? Because it's a small portion. It's only 10% of total assets. Now we look at Regency Partners, our third company, and notice the total assets are $2.2 billion, and the property, plant, and equipment is $2.1 billion. It's almost all of, over 90% of their total assets is property, plant, and equipment. So they show it in detail. Each type of asset listed, then the accumulated depreciation subtracted out to get the total property, plant, and equipment. Now, in our examples in the textbook, we'll often have, equipment less accumulated depreciation, buildings less accumulated depreciation. We don't really want to do that. I've never seen it in a corporate financial statement. So what's best to do is list land first because it's not depreciable. List all your depreciable assets by category, get a total, subtract out accumulated depreciation to get the total or net amount of property, plant, and equipment. Then we list the other assets to get the total. And I think even though this GAAP requires us to report derivative assets separately, this is so immaterial I think I wouldn't have done it. Okay? I would lump it together with other stuff. So we don't have any material items on the financial statements. Then we get the total assets. And we come down to the total liabilities. We start with current liabilities. And we list them all. And again, I wouldn't have a $1 current liability. And we have then total current liabilities. Then we list the others until we come down here into the equity section. Okay? So I think it's a good illustration that what we care most about, care most about is current assets, current liabilities, getting those right. Okay? And in separate sections. We've got to get the category. We got to get the things that belong in the current section in there, and nothing that doesn't belong in there, and get that total, get that right, and then everything else is just added on at the end. Okay? And what sections you use and what categories you use depends on how significant those items are, how material those items are to the total assets and to the total liabilities. I hope you enjoy our discussions this week on the balance sheet.